NVIDIA just offered to backstop $250 billion worth of OpenAI's compute costs, and the market dumped them for it. Because for the first time, Wall Street asked the question that changes everything. Is NVIDIA propping up its own revenue? Here is what this deal actually is. NVIDIA is promising to back $250 billion of OpenAI's compute spend, money OpenAI does not have. SoftBank is building a data center for a company that is losing at least $9 billion a year, and the GPUs that go inside that data center, sold by NVIDIA, backed by NVIDIA, paid for eventually by NVIDIA. The snake is eating its own tail, and they want you to call it infrastructure. This is not the AI revolution. This is the most expensive circular financing scheme in corporate history. I'm Marcus Cole. This is TechWatch AI, where we follow the money the financial media won't touch. Let's get into it. The story is this. NVIDIA has offered to backstop $250 billion worth of compute costs for OpenAI as part of a larger arrangement involving SoftBank. On top of that, there are reports of a $350 billion financing package for the GPUs that would go inside the data center SoftBank's subsidiary, SP Energy, is supposed to build in Texas. Now the official story, the one the business press ran with, is that this is a sign of AI's inevitability. NVIDIA believes in the future. Big money believes in the future. Everyone believes in the future. Here is what that story left out. SP Energy has never built a data center, not one. They took an old 3M manufacturing campus in Texas, and they are, allegedly, turning it into a 70-megawatt facility. For that conversion, they raised just under $1 billion in debt. And that debt is already trading badly. The market is already pricing in the possibility that SoftBank cannot pay it back. And this is before the $350 billion deal, before any of the larger numbers, on a deal for a single campus conversion, not even a real data center build. The market is nervous. So the question you should be asking is, if the small deal already looks shaky, what does a $350 billion deal look like? SP Energy has never built a data center. NVIDIA is backing $350 billion for a company whose only experience is converting an old factory. That is the foundation of the AI revolution. Let me explain circular financing because this term gets thrown around and most people glaze over it. I want you to actually feel what it means. Imagine you own a restaurant. Business is slow. So you go to your food supplier and say, "Look, I need you to lend me $10,000 so I can keep buying food from you." The supplier agrees because if you close, they lose a customer. So now you have $10,000. You spend it buying food from the supplier. The supplier gets their money back. And you are left with a restaurant full of food, no customers, and a loan you still owe. That is circular financing. The money goes out and comes back to the same pocket. Nothing real is created. No new customer appears. The only thing that changes is the debt. Now scale that up by a factor of several hundred thousand. NVIDIA sells GPUs to OpenAI. OpenAI pays for those GPUs using money raised from Amazon, Microsoft, and SoftBank. Amazon, Microsoft, and SoftBank get that money back because OpenAI spends it on Azure, AWS, and their data centers. So those companies invest in OpenAI, OpenAI hands the money back, and the whole loop starts again. According to one analyst, 27% of Google Cloud's revenue in 2026 and more than 48% in 2027 is projected to come from OpenAI and Anthropic. Barclays estimates 13% of Amazon Web Services revenue in 2026, rising to over 18% in 2027, comes from the same two companies. So when you see headlines saying Google Cloud grew 28% this quarter, you now know what is doing the growing. It is OpenAI and Anthropic handing back money that Google and Amazon gave them. They are celebrating their own earnings reports and calling it AI adoption. Now you might be thinking, but the checks are clearing. The revenue is real. Money is money. Does it matter where it comes from? And you are not wrong that the money is technically real. But think about what you are valuing when you value a company. You are valuing its ability to generate revenue from independent customers who chose to pay because the product was worth it. Not from a loop of investors recycling each other's capital. When the loop stops, when OpenAI cannot raise its next round, Google Cloud's revenue does not just slow down, it falls off a cliff. And every investor who bought Google stock because of AI-driven cloud growth finds out they were holding something very different from what they thought. So let's follow the chain. Because this deal does not exist in isolation, it is one link in a chain that goes NVIDIA to SoftBank to OpenAI to Oracle. And every single link has a problem. Start with NVIDIA. Their stock dipped close to $190 this week. Why? Because the market looked at this backstop announcement, and instead of celebrating it, they got nervous. They started asking, why does NVIDIA need to do this? If GPU demand were genuinely diverse and growing organically, NVIDIA would not need to backstop a $350 billion deal for a company losing billions a year. They would simply sell to the people lining up to buy. The fact that they need to engineer this deal tells you something about their demand pipeline. Roughly 50 to 60% of NVIDIA's recent quarterly revenue came from just 3 customers. That is not a diversified business. That is a business dangerously dependent on a small number of buyers who are themselves dependent on debt. Now move to SoftBank. SoftBank, to fund the $22.5 billion it owed OpenAI by end of 2025, had to sell all of its NVIDIA stock, then take out a $15 billion margin loan against its ARM holdings. That is not an investor with money to spare. That is an investor who is nearly tapped out, trying to keep a deal alive by liquidating assets. And yet SoftBank is now reportedly planning to put in another $30 billion. Where does that money come from? The honest answer is, nobody has explained it clearly, because the money is not really there. Now to OpenAI. OpenAI lost at minimum $9 billion in 2024. That number is probably higher. They are projected to lose $15 billion by 2029, and again that projection is almost certainly optimistic. They need to raise money constantly just to keep operating. In the space of 7 months, their stated fundraising target went from $17 billion to over $100 billion. That is not a company scaling up. That is a company whose burn rate keeps surprising even itself. And finally, Oracle. Oracle has taken on $56 billion worth of debt. They have $248 billion in upcoming lease obligations. Their only major tenant for their AI data centers is OpenAI. And for OpenAI to afford its $300 billion 5-year agreement with Oracle, they would need, in the final year of that contract, to spend more than the entire annual revenue of Microsoft Azure. In 1 year, one company. Microsoft Azure's 2024 revenue was approximately $75 billion. OpenAI's Oracle contract ends at $90 to $100 billion in a single year. They would need to be larger than the biggest cloud platform on earth. That is not a plan. That is a fairy tale written in a term sheet. Now I want to talk about something that happened at the same time as this NVIDIA announcement, because the timing matters. OpenAI cut the price of their cheapest model by 80% and their middle model by 20%. The official story, they found efficiency gains. They improved the model. They are passing savings to consumers. Here is the reality. An 80% price cut is not an efficiency gain. If you found 80% efficiency in your cost structure, you would not give it away. You would use it to stop losing $9 billion a year. The reason you cut prices by 80% is because customers are leaving or threatening to leave, or you're desperately trying to stop a competitor from taking your market share. This is a company simultaneously claiming record revenue growth and slashing prices by 80%. Those two things are not compatible with a healthy business. In a healthy business, if your revenue is genuinely growing and your product is genuinely in demand, you do not need to cut the price by 80%. You raise it or you hold it. Now layer on top of that the leaked report from OpenAI's CFO suggesting that July revenue was higher than all of Q2. That report never stated what the revenue number actually was. It said annualized revenue from July, meaning 1 month multiplied by 12, would be higher than Q2 total revenue. That is not a revenue figure. That is a legal construction designed to make journalists write a certain headline. And it worked. Every outlet ran. OpenAI posts record revenue. Not one ran. OpenAI leaks a carefully worded metric that does not actually tell us the revenue. Here is where it truly peaks. Anthropic, by one estimate, is going to spend $76 billion on Google Cloud next year alone. $25 billion on Amazon Web Services. These are companies whose revenues, whatever they actually are, cannot come close to covering those infrastructure costs. And yet their cloud providers are posting growth numbers, and their investors are celebrating AI adoption. You are watching people celebrate a restaurant's growing revenue without noticing that the restaurant's only customers are the investors who own the restaurant. Anthropic and OpenAI have over $1.1 trillion in commitments. $1.1 trillion. That is a number so large it has stopped feeling real, which is, I think, exactly how they need it to feel. Now I want to address something directly, because I know what some of you are thinking. You have been hearing versions of this argument for months. The bubble keeps going. Maybe the analysis is just wrong. That is a fair challenge. And here is the direct answer. Bubbles do not pop when the analysis is correct. They pop when the money runs out. And money runs out when the debt market stops lending. The analysis has been correct for some time. The money has not run out yet because the debt markets have kept lending. But look at what is happening at the edges. Amazon's bond sale demand this week came in at 1.6 times. Normally, a company of Amazon's credit quality gets 4 to 5 times demand. They got 1.6. Oracle's credit rating is heading toward junk. CoreWeave's debt is trading above 900 OAS, what traders call the death zone. Blue Owl pulled out of a $10 billion Oracle deal, citing unfavorable economics. 41 data centers were canceled, shelved, or delayed in a 6-week window. These are not opinions. These are facts in the public record. The question is not whether the bubble exists. The question is when the debt market has its first day where it simply says no, and that no spreads. The last time the phrase financial innovation appeared this often in business coverage, it was in reporting on the mortgage-backed securities that caused the 2008 financial crisis. These are not derivatives. The scale is different. But the pattern, ignoring fundamentals, believing the number will keep growing, assuming someone else will be left holding the loss, that pattern is identical. So let me tell you what I think happens next. Not vague predictions. Specific. Named. With timelines. First, this NVIDIA SoftBank SP Energy deal does not get built as announced. SP Energy will either fail to secure the construction debt at the scale required, or the timeline will slip so badly the deal gets renegotiated into something much smaller. I think we know this within 12 months. Second, OpenAI does not reach an IPO at anything close to a $300 billion valuation. Their burn rate will require another fundraise before any public offering. Each new raise at higher losses makes the IPO math harder. Within 18 months, the IPO is either shelved or repriced dramatically downward. If it happens at all, it happens because someone needs liquidity, not because the business can support the number. Third, Oracle is the first major public company directly implicated in the unwind. Their debt load, their dependency on OpenAI as essentially their only AI tenant, and their credit downgrade trajectory all point toward a moment where they cannot refinance on acceptable terms. I think this becomes a visible crisis within 2 years. Fourth, and this is the one I want you to remember, the first time a major AI data center debt deal goes into formal restructuring or default, The speed of what follows will surprise everyone, because every other data center deal is structured similarly. The moment one falls, lenders look at their entire portfolio, and the answer they find will not be comfortable. The question was never whether this was a bubble. The question was always who gets out before it pops. And the answer, as always, is the people who lent the money, not the people who built the fantasy. I want to leave you with one thought. This week, the market punished NVIDIA for making an announcement. Not a failure, not a scandal, an announcement. NVIDIA said we are going to back $250 billion of OpenAI compute costs. And investors sold, because for the first time in a long time, the market looked at the announcement and asked, if the demand is real, why do you need to manufacture it? That question, that single question, is the most important thing that has happened in this story in months. Not the size of the deal, the market's reaction to it. When the crowd stops cheering and starts asking, the game has changed. If you want to follow what happens next, subscribe. I publish regularly. No hype, no predictions dressed up as certainties, just the numbers and what they actually mean. I will see you in the next one.